algorithms are there to create volatility and liquidity. They're written by a programmer, and they have to be written to go somewhere. Okay, and where are they written to go? These technical areas that we're putting out, there's no doubt. They want to shake out the longs, and they want to get people short. That's what algorithms do. And there's a way to look at these, and it's a way to track them. I'm able to take advantage of what they're giving me and keep printing the money, man. That's what we do. And we do it every day, hundreds of times.
This is Richie Nazzo. He started on the New York Stock Exchange floor in 1965, making $60 a week. He ended up with Wall Street's biggest firm paying him $115,000 a month just to make sure he was the one trading their orders. And he just told the whole secret. The algorithms are programmed to hunt the levels everybody is watching. So what's the most watched level of them all? Trend lines. And that's exactly why trendline traders keep getting stopped out. You sell the bounce, they shake you out. You buy the break, they feed on you. Same line, two losers. But once you understand the game, you can flip to the other side of that trade, the side that gets paid. And in this video, I'll show you exactly how, step by step. Now, I know what you might be thinking. Sounds like another strategy with insane results. So I'll also tell you how to backtest all of this yourself. Simple, fast, free, no coding required. Let's get straight to it. Most traders can define a trend line, but almost nobody can explain why it works. In an uptrend, price keeps printing higher lows, and a trend line connects those swing lows from below. In a downtrend, price keeps printing lower highs, and the trend line connects those swing highs from above. That's it. A diagonal support in an uptrend, a diagonal resistance in a downtrend. Think about who creates a clean, steady trend. It's not the panic buyers chasing every green candle, and it's not the bottom fishers waiting for a crash. It's the patient money. Funds and algorithms running passive buy programs. They want the asset, but they refuse to chase it. So every time price dips back into their zone, they buy. Not aggressively, just consistently. Price lifts, they stop buying. Price dips again, they buy again. Repeat that 5 or 6 times, and congratulations, the chart just drew a trend line for you. The moment that buy program is filled, or the fund changes its mind, the behavior stops. The line doesn't weaken. The buyer behind it disappears. Now that you know what's behind the line, let's draw one properly. Rule number 1. You need an actual trend. This sounds obvious, but half of the terrible trend lines on the internet are drawn inside ranging markets. If price is moving sideways, there is no trend to line up. Skip it. Use horizontal levels instead. Rule number 2. A real trend line needs 3 touches. With 2 points, you can connect literally anything on a chart. The third touch is what validates the line, because it proves that the market reacted to that level more than once. Rule number 3. Never cut through candle bodies. Wicks are noise. Bodies are decisions. If your line slices through a wick by a few ticks, fine. The market isn't a precision instrument. But if you have to cut through a full candle body to make your line work, the line doesn't work. Delete it. Rule number 4. Give the line context. Zoom out. A trend line drawn on 12 candles is a doodle. You want to see roughly 60 bars or more behind your line on whatever time frame you trade. That's about 1 hour of context on the 1-minute chart, about 3 trading days on the 15-minute, about 2 weeks on the hourly. The more history behind the line, the more real money has actually interacted with it. And one more thing, treat the line as a zone, not a laser. Price touching 2 ticks above or below your line is still a touch. Traders who demand pixel-perfect touches end up missing every setup or redrawing their lines 40 times a day. Now, a warning that almost nobody gives you. A trend line can be too good. When a line has been respected 5, 6, 7 times, everyone can see it. Every trader on every time frame has that line on their chart, and when everyone is leaning on the same level, the market has a nasty habit of taking it away. And here's the mechanical reason why. Think about what a touch actually is. Every time price comes back to the line, buyers had a chance to push it away, hard. If price bounces and flies, the buyers are strong. But if price keeps returning again and again, barely bouncing, hugging the line, that's not strength. That's the buying behind that line running out. Each weak bounce is the buy program getting closer to empty. So forget the old rule that more touches make a line stronger. More touches make a line more relevant. But if price can't get away from it, the break is coming. So when you see a beautiful line with 6 perfect touches, don't get excited about bounce number 7. Start preparing for the break. We'll come back to this. Alright, first setup, and we start with the classic, trading the bounce. Done properly, this is the lowest risk entry in the entire trendline playbook, and I'll show you exactly why with a live trade. The logic is simple. If a valid trendline represents a buy program that's still active, then every return to the line is that program buying again, and we want to buy with it. The edge isn't in the line. The edge is in where the line lets you place your stop. But not every line qualifies. Here's the checklist before I touch anything. 1. The line has at least 2 to 3 clean touches already, so the behavior is confirmed. 2. There is real data behind the line, not 5 candles. We want days of history between the first touch and now. 3. The entry is close to the line, because the whole point of this setup is that your stop sits just on the other side, and if price is far from the line, that advantage is gone. Let's take a live one. I'm on the chart right now and price is in a clean uptrend, higher lows all the way, and I have a trend line under them with 3 confirmed touches. First touch was 8 days ago, so the data requirement is covered. Right now, price is pulling back and it's coming into my line, and this is the moment where most beginners panic buy the touch. I don't. I want the market to show me the buyers are actually here. Price taps the zone, dips a few ticks under the line, and now I get a strong bullish candle closing right back above it. That's my confirmation. The dip below was just WEEX getting cleared. I'm buying now at the close of that candle. My stop goes just below the line and below that little wick, tight, because if price trades cleanly through this line, the buy program is gone and I have no reason to be in this trade. My first target is the most recent swing high, and I'm not using a fixed take profit for the rest. As price pushes up and prints a new higher low, I trail my stop under the trend line and keep moving it up along the line. Look at this. Price is lifting off the zone. New impulse, new higher low forming. I slide the stop up. The trade is now risk-free, and I haven't done anything except follow the line. This is the beauty of the bounce done properly. The line gets me in, the line manages the trade, and the line will get me out the moment it breaks. No opinions needed. One more thing on this setup. It lives and dies with the instrument. Some markets respect trend lines beautifully. Others chop through them all day. Don't take my word on which is which. Backtest your instrument. Count how often clean bounces actually follow through, and let the data pick your market for you. And I'm not leaving you alone on this. My free backtesting guide is in the description. It walks you through the whole process step by step. No coding needed. Now, everything I just showed you works when the line holds. So the obvious next question is, what about when it breaks? And this is where trend lines go from useful to dangerous, because the break is where the market runs its favorite scam. Here's the scene. Downtrend, clean descending trend line, 3 touches. There are 2 types of traders staring at this exact line right now. Trader number 1 sells every retest, stop just above the line, textbook. Trader number 2 waits for the break because he's been taught that a trend line break means the trend is over. So when price pushes above the line, he buys the retest, expecting a new uptrend. Now watch what the market actually does. Price pushes up through the line. Trader number 1, the seller, stopped out immediately. His stop was right above the line. So far so good for trader number 2. The line broke, he's buying. And then price rolls over and dumps, new low. Trader number 2 stopped out too. Same line, both sides destroyed. And the downtrend never actually ended. How is that possible? Because of something almost nobody checks. The line broke, but the structure didn't. A trend line is something you drew. Market structure is something the market printed. In a downtrend, The trend is defined by lower highs and lower lows, and the trend only actually reverses when price breaks above the last significant lower high. That's the real level. The trend line can break 50 points below that level and the market is still bearish, which means every trend line break that happens below the last lower high is not a reversal, it's bait. And this is the mental shift that changes everything. Stop asking, will the line hold or break? And start asking, where are the other traders trapped? A trend line is a map of stop losses. Sellers park their stops just above a descending line. Breakout buyers pile in just above it too. That's a pool of orders sitting in one place, and pools of orders are magnets. The market is drawn through the line, fills all of that, and then goes back to doing what the structure said it was doing all along. The break wasn't a signal. The break was the liquidity grab. So from today, when you draw a trend line, you're drawing two things at once: a potential entry for you and a marked grave for everyone trading it blindly. But let's be real, manually drawing trend lines can be time consuming, and sometimes you miss one completely. That's why I personally use the price action toolkit from Flux Charts. It actually draws trend lines automatically based on the major swing points I just showed you. What I love about it is that you can adjust the sensitivity, so you can see either just the clean major trend lines or every possible minor line if you'd like to scalp. And it even lets you choose whether a trend line is invalidated when price closes beyond it or just when the wick goes beyond, which is super powerful if you trade fakeouts or wick rejections. That's just one of the many features inside Flux Charts. And here's the best part, 90% of their indicators are completely free. If you want to try them out, click the link in my description and use this code at checkout for a special discount. Alright, let's get back to the video. So if most trendline breaks are traps, how do we trade the ones that are real? That's setup number 2, and it has 3 conditions that filter out almost every fake break automatically. Condition number 1, the trend has to be dying before the break, not because of the break. Remember the touch point myth from earlier? Look at how price has been touching the line. Price hugging it, momentum fading, the angle of the trend flattening out. And above all, look at structure. Is the market failing to print new highs? An uptrend that stops making higher highs is an uptrend on life support. That's the context we need before the line even breaks. Condition 2, the break has to come with a structural break, not just the line. I want price to break the trend line and take out the last significant swing. In an uptrend, that means breaking below the last higher low. Line break plus break of structure together is the market switching from higher highs and higher lows to the opposite. One without the other is noise. Condition 3, and this is the rule almost nobody applies. Before entering, you need a line on the other side keeping you safe. After the break, I don't touch anything until price gives me a high and a lower high on the new side, so I can draw the opposite trend line, the new descending line above price. That line is my risk manager. If I can't draw it yet, I don't have a trade yet, no matter how juicy the break looks. Yes, this means skipping breaks that immediately melt without you. It hurts. Skip them anyway. Chasing a vertical move with no reference line above you is how one trade undoes a month. I'm watching an uptrend that's been going for weeks, but look at the last 3 touches on the trend line. Each bounce is smaller than the one before, and the most recent push completely failed to make a new high. Lower high on the chart. Condition 1, check. This trend is exhausted. Now price is coming down into the trend line, and this time it doesn't bounce at all. It slices through with a big bearish candle, and 2 candles later it takes out the last higher low as well. Line broken, structure broken. Condition 2, check. Most traders are shorting right here, into the flush. I'm waiting. Price pulls back up, prints a high, rolls over, prints a lower high, and now I can finally draw my new descending line above price. Condition 3, check. I have my safety. Price is rejecting off that pullback right now, previous support acting as resistance, and I'm entering short here. Stop goes just above the new descending line. Target the next major swing low on the left. And from here, the management is identical to the long trade, just mirrored. Every new low or high, I trail my stop down along the descending line. Price is stair-stepping down, lower high, lower low. I follow it with the stop, and I stay in this short until the market breaks my line and tells me the move is finished. One warning on management. After a real break, pullbacks are normal, extremely normal. Price coming back to retest the broken line does not mean the trade failed. It usually means late sellers are getting their last chance. If you slam your stop to break even 2 candles after entry, the retest will take you out right before the real move. Give the trade the room the structure allows, not the room your anxiety allows. And remember, don't take any of this on faith. Run it through the free backtesting guide in the description and let your own numbers convince you. I really hope this video saves you from the traps that cost money for years. All I ask in return is to leave a comment telling me how long you've been trading. 1 week? 6 months? 2 years? 10? I read everything, and I love seeing who's actually on the other side of the screen. See you guys in the next one.